Hello, everyone. My name is Mason Thomas, and today I'm going to be talking about China's hesitancy with American banks expanding in China. First, I'm going to talk a little bit about the context of the issue, beginning with the topic of historical trade. I will start with when China joined the World Trade Organization, WTO, in 2001. Both countries have benefited from trade. However, the relationship has also faced friction due to trade imbalances, differing trade practices, and competition in key industries. These tensions intensified in recent years with the U.S. accusing China of unfair trade practices and implementing tariffs, and China responding with its restrictions. The financial sector has been a particular point of tension because of the U.S. is seeking more market access in China, while China remains cautious about allowing foreign financial influence in its economy. Then we have the aspect of national security concerns. China has been protective of its financial sector because it is essential to the country's economic stability and national security. The Chinese government is concerned that allowing foreign banks too much influence could lead to financial instability or give foreign powers a degree of control over their economy. Continuing, we have China's ambitious financial and economic reforms. Since the early 2010s, China has been pushing for a more open and modernized financial system, allowing limited foreign access in sectors that include asset management, insurance, and wealth management. However, the opening has been gradual and controlled, with China keeping a tight hold on foreign influence to protect its domestic industries and prevent market disruptions. Foreign banks continue to face restrictions on ownership, lending practices, and capital requirements. China makes sure that American banks in particular would experience higher restrictions. Then there are the differences in standards. China's regulatory framework for financial institutions differs significantly from Western models, with heavier government involvement and control. Chinese authorities expect foreign banks to adhere to local standards, but U.S. banks often find these requirements complex and challenging to navigate. Then there is the aspect of global financial competition. The US and China are increasingly viewing each other as economic and strategic competitors, especially as China aims to challenge the US dollar's dominance in global finance and promote the renminbi, RMB, as an alternative. American banks represent the global financial influence of the US, and their expansion in China could be seen as both an economic opportunity as well as a potential strategic threat. Lastly, we have its recent developments. Recent political developments such as sanctions, trade disputes, and conflicts over technology transfer have further heightened the sensitivity of cross border businesses and sectors with security implications, which would definitely include banking. This has led China to hesitate to allow the U.S. financial institutions to operate freely within Chinese borders. Continuing on, we have the history of the issue. Starting in 1949 through 1978, there were early restrictions and a state controlled economy. After the establishment of the People's Republic of China in 1949, the Chinese economy was largely closed to foreign businesses, with strict controls over banking and finance. The sector was dominated by state owned banks that were seen as extensions of the government. Foreign banks, including American ones, were generally prohibited from operating in China because the country was focused on maintaining full control over the economy and minimizing external influences. Continuing into 1978 through the 1990s, we began to see reforms. Under President Deng's leadership, China began its economic reforms in 1978, opening up select areas of the economy to foreign investment, and they started to move toward a socialist market economy. Foreign banks were still heavily restricted, however, but China began to experiment with special economic zones that allowed limited foreign investment, mainly in manufacturing. Throughout the 1980s and early 1990s, China allowed a few foreign banks to open representative offices primarily in the special economic zones. However, these offices could not offer full banking services, but they marked a step toward increased foreign participation in the Chinese financial sector. Then in 2001, we have China's World Trade Organization accession. As part of the WTO agreement, China allowed foreign banks to operate in the local currency RMB, and they gradually eased restrictions on their activities. However, these foreign banks were still subject to strict controls on ownership, geographic limitations, and capital requirements. And then heading into 2001 and 2010, the incremental market entry was introduced. Throughout this time, American banks, along with other foreign banks, sought to expand their presence in China. Large banks, what I mean by those is banks such as JP Morgan Chase, Citibank, Goldman Sachs, started to open branches while others pursued joint ventures or minority stakes in Chinese financial firms to evade those restrictions. Foreign banks struggled with a variety of challenges, including restrictions on the types of services they could offer, limitations on RMB dominated transactions, and high capital requirements. They also faced stiff competition from state owned Chinese banks, which continued to dominate the market. Lastly, this will lead us into the 2010s when tension was growing in the US China competition. In 2013, China launched the Shanghai Free Trade Zone as an experiment in financial liberalization, where foreign banks received fewer restrictions on currency exchange and financial services. Around the same time, the rivalry between the US and China intensified, especially as China sought to establish its global financial influence, reduce its dependence on the US dollar, and promote the RMB internationally. These ambitions limited China's willingness to open its financial sector fully to American banks, which it saw as carriers of US influence. And now we're going to take a look at the scope of the issue today, starting with economic growth and financial market access. China is still continuing to pursue financial sector reform as part of its broader economic strategy. It's aiming to modernize its economy and attract foreign investment. In recent years, China has partially opened its financial markets to foreign banks to promote capital inflows and support underserved sectors. Those sectors including sectors such as wealth management, asset management, green finance. However, China's opening is selective and American banks are still facing hurdles. That leads us right to the topic of compliance and operational constraints. American banks face challenges aligning their operations with Chinese standards, mostly in data privacy, cybersecurity, and capital controls. China's evolving regulations, particularly around data handling and cross-border capital flow, pose unique compliance hurdles that can be costly and complex for foreign banks to manage. Recently, China has become more cautious of foreign influence over sensitive financial data. This is reflected in laws that require foreign banks to store customer data within China, a regulation seen as a way to maintain security without placing additional constraints on U.S. banks that must manage both data standards from the U.S. end and the China end. Then we have the national security concern. The U.S. has imposed sanctions and export controls targeting Chinese technology firms, while China has restricted foreign companies' access to sensitive sectors. Those tensions influence China's hesitancy to allow foreign banks full access because they want to limit the U.S.'s influence over its economy. China's government is also weary of American banks handling financial data on Chinese citizens and companies, fearing that it could be subject to misuse. Then we have the idea of technology transfer concerns. American banks often possess advanced financial technologies, including AI-based investment platforms and sophisticated risk management systems. And China wants to leverage those expertise areas to modernize its financial sector, but they are cautious of intellectual property transfer or IP transfer, fearing it could give U.S. banks a competitive edge while compromising China's strategic interests. And then we have China's dual circulation strategy. Under the strategy, China emphasizes strengthening its internal economy while engaging selectively in global markets. This basically points to prioritizing domestic banks to build resilience and reduce reliance on foreign banks. Consequently, foreign banks, including U.S. banks, have limited access to sectors deemed vital to China's economic security. Lastly, I'm going to talk briefly about the American banks making a strategic response. To navigate China's regulations, many American banks formed joint ventures with Chinese financial institutions. This approach would allow them to offer certain services while adapting to the local requirements. And they are also starting to expand in sectors that China views important, such as green finance and asset management. So you may be asking, what's at stake? Well, let's start with the topic of economic growth and market potential. So American banks see China as a major growth market with significant potential, and China's financial services sector, especially in wealth management, consumer lending, and corporate financing, is large and growing. Limited access means lost revenue opportunities for American banks and limits the U.S. financial sector's influence in the global economy. This leads us into the idea of financial stability. From a global perspective, as the world's second largest economy, financial stability in China impacts the global financial system of the world. Allowing American banks to operate freely could increase market integration and create the new investment opportunities, but it also raises the risk of cross-border financial problems, especially during economic crises. A crisis in China's financial system could have ripple effects impacting US banks and at large the global economy. Then we have data privacy and security. US banks operating in China have to navigate strict data localization laws, which require them to store Chinese consumer data within China, and it restricts cross border data transfers. Compliance with these rules can be costly and technically challenging and can also impact US banks' operational efficiency. Now we have the geopolitical influence. The US has historically exerted global influence through its financial system, particularly through denominated transactions and financial norms set by American banks. Gaining access to the Chinese market is important for maintaining this influence, especially as China promotes the RMB as an alternative to the dollar. Restricted access limits American banks' reach and weakens the US's leverage in the global financial sector. Lastly, we have the idea of financial innovation and competition. Access to China's market could provide American banks with unique insights, data, and experience in a rapidly growing economy. This knowledge could be used to develop new products or expand similar services in other markets. Limited access, however, would result in missed opportunities to capitalize on new innovations, obviously, which would impact the competitive edge that U.S. banks would have on the global sector. And now I'm going to talk a little bit about what is being done currently. First, we see the selective openings of China's financial markets. In recent years, China has allowed foreign banks to enter some segments of its financial markets, including wealth management, asset management, insurance, and securities. This gradual opening aims to attract foreign capital and expertise to areas that align with China's economic goals, such as green finance, consumer finance, and retirement services. Now let's transition to the U.S.'s diplomatic pressure along with trade negotiations. During trade negotiations under the Trump administration, the U.S. pushed for increased access for American financial firms in China. Although the Phase 1 trade deal in 2020 did not specifically mention financial services, it set a foundation for ongoing negotiations about market access. And today, American diplomats continue to press China for expanded access and transparency in their financial markets. Then we have the topic of partnerships and joint ventures. Many American banks operate in China through partnerships with Chinese financial institutions. These joint ventures allow U.S. firms to access the Chinese market while abiding to those local regulations. Partnerships, however, they often limit U.S. banks' operational controls, so firms that are balancing the joint ventures with efforts to secure greater independence, they do it when it's possible, but it's not always possible. Also, in areas that align with China's national priorities, such as, once again, green finance, American banks have found more open doors and opportunities in those sectors that China sees important. And then this would lead us to investments in digital finance. Some American banks are investing in digital platforms within China, focusing on areas like online payments, digital wealth management, and AI-driven banking services. By entering those tech partnerships or digital services, these banks can reach Chinese consumers while adhering to China's emphasis on and importance on digital finance. And then we still see China continuing to have their reforms. China is refining their financial regulations to allow controlled access for foreign banks while still protecting their strategic and important sectors. These reforms include adjustments in capital requirements, risk management standards, and investor protections aimed at fostering more competitive but carefully controlled financial sectors. And then lastly, we have the topic of global financial institutions. China's goal to internationalize the RMB affects how they regulate foreign banks. American banks operating in China may eventually face unique requirements tied to China's initiative, especially if China restricts foreign access to key financial services to prevent their RMB-based capital outflows. And then we have my policy recommendations. Starting out, I would like to mention bilateral financial diplomacy. This mainly starts with establishing formalized communication between the U.S. and China, mainly between the financial regulators to address specific concerns around problems such as compliance, risk management, and cross-border regulations. I also think we should develop mutual recognition agreements where both sides acknowledge the equivalent of certain regulatory standards. This would allow American banks to operate with fewer compliance burdens in China. This then leads me to the data privacy protection. We should work together to define clear standards for data localization, storage, and sharing. This would also address China's national security concerns regarding the financial data while reassuring American banks that the operational requirements will be transparent and not crazy restrictive. Along with that, we should also have incremental market entry. We should propose a phased approach where American banks initially offer limited services or operate under joint ventures with Chinese banks, gradually expanding as trust is established with the Chinese. This would allow Chinese regulators to evaluate and monitor foreign financial activity more comfortably and see how we are doing and adjusting to their market. Relating back to that point, I think we should strongly support joint ventures and collaborations. This approach could ease concerns over market dominance by promoting collaboration rather than being seen as competition. I think we should also promote compliance through positive reinforcement. There should be incentives offered, like the lowering of capital requirements or favorable tax treatments for American banks that meet specific standards in China. This approach encourages American banks to adhere to the local guidelines while also making it economically viable for them to operate. Finally, we have the concept of cultural and knowledge exchange programs. We should facilitate cross-border training programs and exchange initiatives for regulators, compliance officers, and financial experts. A stronger understanding of each other's financial landscapes, concerns, and operational styles can pave the way for a more trustworthy relationship between the U.S. and China. And that is my project on China's hesitancy with American banks expanding in China. Thank you for listening.